Welcome to Chit Chat Stocks. Before we get to this episode, we want to talk about our friends at Public. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield that remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA-registered, SIPC-insured, US-based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks, paid for by Public Investing. Full disclosures in the podcast description.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
Welcome into another edition of the Chit Chat Stocks podcast. My name is Brett, and as always, joined by my co-host, Ryan Henderson. Today we have our annual Nelnet update. Our baby Berkshire. Well, it's not ours. We're just one of the shareholders. We've been shareholders for quite a long time now. This will be year 5 going on once we hit the December time period. So it's been a long time owning Nelnet. They just filed their annual report. The stock is hitting close to an all-time high. And as we went through the numbers here, we still think it can be cheap and provide attractive returns for investors going forward. We've read the annual report. We've read the shareholder letter that was released last week, and we're ready to analyze the company and its future prospects and what their businesses look like in 2025. We're going to get right into it, but first, 2 housekeeping items. If you like this episode, if you like any of the podcasts that we do, please give us a review on Apple Podcast or Spotify, preferably 5 stars. And if you want a written research report to go along with this episode, subscribe to our Substack. The link is in the show notes, where you can also chat in our free chat community. All right, Ryan, we're revisiting Nelnet here, providing our 2025 update. And I will say we probably plan on doing these once a year along with the shareholder letter release. For anyone that has not heard of this company before, what's the story here and why do we like this small cap, well, maybe mid cap now, conglomerate?
Yeah, I'll give a brief overview of the entire operation for anyone who has never heard of the company. Then we can get into the various actual subsidiaries and the performance as of late. So if you're very familiar with Nelnet, you can go ahead and feel free to skip around and find us once we start talking about the actual subsidiaries. But Nelnet really got started in the student loan origination business. This was quite a lucrative place for some time. But in 2008, the federal government took the lending process in-house, or the lending business. And correct me if I'm getting any of this wrong, Brett. It's been a while since I brushed up on their history.
2010, but
2010.
That's not really relevant. Yeah.
So at that point, Nelnet had this massive pile of student loans that they had written over time, and that there was going to spit off cash for more than 2 decades into the future, but they couldn't really write new ones. So over the last roughly 2 decades, they've been reallocating that cash flow into new businesses. Part of that has been acquiring ancillary businesses to the education sector. Part has been developing a loan servicing business, and part has been finding a sort of new ways to lend money, which we're going to talk about, has become even more so relevant really this year or so. Brett's going to dig into that a bit, but they've now really passed their peak runoff from that student loan portfolio, and the other parts of the business are becoming more and more important. here are some of the thoughts we put together last time we spoke about them to kind of encapsulate what our vision and our goal for maybe sort of our thesis and thoughts on the company were. So, Brett, on March 7th, 2023, you said, I like the management team. The quantitative track record speaks for itself, which we have covered in the above sections, but the qualitative is just as important. Nelnet thinks long-term, has long-term tenured management, doesn't mess around with bullshit earnings, quote unquote bullshit earnings, and could care less about Wall Street. Plus, when they do communicate with investors, they do so clearly each year with the annual letter and annual report. I don't think that's changed. I think that all pretty much still holds true today. And then on that same day, I wrote, it gives me some confidence to know that Michael Dunlap owns 42% of the shares outstanding. Jeff Nordick, who's really kind of the day-to-day president. Michael Dunlap is the chairman. Nordick owns basically $50 million worth of stock, which I assume is a big chunk of his net worth. And then on the deploying capital part, I thought, I said, I like the fact that there are now a number of greenfield investment opportunities under their umbrella. Solar, fiber, Nelnet Bank are places where they can really put as much capital to work as they want. I think on some of those, I maybe wish they put a little less capital to work. I'm specifically talking about a certain construction business, which they've been forthright about and quite honest about some of the issues there. So we're going to dig into that. But I think a lot of this still holds true. The financial services portion of things has gotten a little more diverse, I would say, but also probably a little more confusing. So for anyone that's followed the story, doesn't quite follow what all is going on, Brett's going to break down some of that. And then just to put some numbers on it, I guess I should pull up the actual year, but Nelnet has compounded book value per share, I believe, at just around 15% for 2+ decades. Do you know
15.7?
15.7? Do you know what year that started?
Since 2004. And that is including dividends getting reinvested. And as we'll get through when we do some of this valuation work and go through each segment, there are plenty of these investments or business subsidiaries where book value is severely understating the true intrinsic value of these businesses. So we think that their actual intrinsic value has compounded at a much higher rate. But we'll get into it. Ryan, we have this table that you included here that they include in every shareholder letter. It is perhaps surprising to see, and this can either be taken in a glass half full or a glass half empty mentality. Since 2015 through 2024, so I think that's 10 years, they have deployed or reinvested a total of $8 billion. Only, let's see, dividends and stock repurchases are only less than $1 billion of that. So most of that is capital redeployed into new investments, new business subsidiaries, reinvesting for growth in some of their subsidiaries. And they've done about $1 billion. Well, was 2023 500 million or 900 million? It's a little blurry on that screenshot. But either way, last year they did $1.1 billion with only a tiny bit being stock repurchases and dividends. So if they're getting good returns on this, perhaps the stock is undervalued with a market cap of just $4.4 billion today.
Yeah, and we're going to dig into all the operations and we're going to value each segment individually, and we'll kind of give more of a holistic valuation towards the end, and everyone can kind of do their own valuation work. I think I know some people are super against some of the parts. I tend to think in this case, if we're holding for a long time, eventually the sum of the parts will be worth something because the earnings will show up eventually. So that's kind of the goal here, is it's long-term earnings, short-term sum of the parts valuation. So let's kick things off with maybe the most confusing division, the Nelnet Financial Services. And for anyone that's not familiar with Nelnet, their naming of each division sucks. It's horrible. So
yeah, it's confusing. We'll call this NFS. Just think of any of this as lending or any fee-based things or investments, kind of financials like their bank. We have the loan book runoff. We have their other third-party securitizations and non-student loans. There's real estate, all this stuff. We're going to get into it here. And how I'd like to envision this episode is we just introduced the company, said how much capital they deployed, given their long-term track record. We're going to unfold all these business segments, and then we're hopefully by the end going to repackage it together and show, or at least explain our thesis in much more succinct with, you'll be able to understand our thesis at the end, because when you look at all these companies and these subsidiaries within the conglomerate, it can get confusing if you kind of don't go in at first and then fold it back up. All right. Nelnet Financial Services, NFS, is the most research demanding part of this company. Within this, we, the shareholders, own a melting ice cube of student loans that Ryan talked about at the start. We have a startup bank, real estate investments, loans held on the Nelnet balance sheet outside of the bank and outside of the existing loan portfolio. We have shares of loan securitizations, and hey, a new startup insurance operation. Now, for time's sake, we're not going to look at real estate, insurance, and any of the other smaller NFS segments because they're not meaningful to the business in 2025. Now, if they become larger, we will cover them in more detail. On this episode, in this segment here, we're going to talk about three things: the loan book runoff, Nelnet Bank, and the non-student loans plus beneficial interest. Those are three segments. So first, let's talk about the loan book runoff. As we've discussed before, they have these legacy student loans that they originated years ago on the company's balance sheet, and they are referred to as FFELP loans. So if they refer to any of that in the shareholder letter or annual report, these are the loans they're talking about. In the last few years, there has been an acceleration in repayments on these loans due to the U.S. government's forgiveness policies or the accelerated repayment stuff that's gone on. It's been quite confusing and volatile. The rules have changed. There's been court cases and all that stuff. Here's what they had to say about it in the 2024 annual letter. Quote, 2024 saw dramatic volatility in prepayments on our FFELP portfolio, and although prepayments have slowed, there always remains political uncertainty in what we can expect going forward. Regardless, we continue to seek out and find strong holdings to be funded in and outside of our bank. So that's what they're taking with the cash flow from these existing loans. The gist of it is that if borrowers repay student loans faster, Nelnet gets less cash flow in total, but it arrives quicker. And based on its current forecast, it should get around $1 billion in future cash flow from these loans, with the largest amount coming in 2025 at $290 million. And after that year, we essentially get less than or around $100 million a year, and then it disappears. I would note that, Ryan, even though this segment is essentially going away, it is still a significant value compared to the $4.4 billion market cap we have sitting here today. And that pretty much sums up that segment. I like that we're getting $290 million in 2025, but after this, each year, it's not nothing, but it's not going to matter much anymore after this year. And what will matter is these next segments, Nelnet Bank and the other securitizations and loans held on the balance sheet.
Yeah, it's kind of nice that as we looked at this a couple years back, the focus has always kind of been on what's left after the loan portfolio. And we almost kind of forget that this thing just churns out $100 million in cash every year and $300 million in cash this year. So yeah, it's some nice cash flow, and they've done a pretty good job, I would say, redeploying it and giving themselves areas to redeploy it as well. One of those being the Nelnet Bank. You want to get into this and how, I guess, maybe give a little bit of context on how this was started. I believe they bought a license for it a couple of years back, and then what are they doing with it now?
Yeah, so they didn't buy it. I think you're thinking of SoFi. SoFi bought the license by acquiring a bank, but Nelnet was one of the only companies to receive a new license from the federal government, and I think it was late 2020 or maybe 2021. So this is an FDIC insured, fully licensed bank in the United States, and it began its first full year of self-funding in 2024. So that was last year. Now, the first 3 years of operations, they were essentially in a de novo period, as they call it, which it's not anything confusing. It just means Nelnet, the parent company, was helping them fund their operations as they get to more scale. You don't want a bank to start off with 10 million of deposits, and then oops, okay, they're out the door. We need a little bit of scale here to get working. And in order, if you read the shareholder letter, you look at this FFELP loan runoff. In order to grow the entire NFS lending operation, management is aiming to grow Nelnet Bank. And they have 4 lending categories: private student loans, parent loans, which is like loans to help parents pay for college, student loan refinancing, and home improvement loans. Unsurprisingly, most of Nelnet Bank's lending products are in the company's circle of competence, which is education. And it has a loan portfolio as of the end of the year of about $645 million. Deposits are a tad complicated. It has a small amount of intercompany deposits from the Nelnet balance sheet. Then there are CDs, Education 529 plans, health saving plans, and sweep deposits to maintain FDIC insurance thresholds at other banks. So essentially, you have the rule where you only have FDIC insurance for one account up to $250,000. But if a bank, say like Bank of America, takes some of your deposits and deposits them at another bank, well, then you can actually get more insurance if, they do these sweep deposits around, and maybe they can promise you up to $1 million insured or something like that. So that's how Nelnet gets some of its deposits, and it takes on commercial deposits from other institutions and brokers, as well as retail deposits. There is plenty of details in the annual report on this one, but they have, essentially because it's really hard to start a consumer bank from the ground up, they're having to be a little bit innovative and creative to attract deposits at first. And at the end of 2024, Nelnet Bank had $1.25 billion in deposits. I would look for this figure to grow in the coming years. I think this is an important metric for investors to follow. Net interest margin in 2024 was 3.39% compared to 2.33% in 2023. The interest rate hikes didn't help in 2023, but I think as the business scales, as this matures, if they get more and more deposits on the balance sheet, we should see this solid net interest margin translate into the building of equity, very solid ROEs here, and helping build capital for the Nelnet corporate balance sheet, which for the NFS segment, building equity, generating good ROE is how we get value created for us as shareholders.
Okay, now there's some other stuff going on in the financial services segment as well. What are these? And I believe they're categorized as other loans. So can you maybe, as much as you can, give us some information on what these are?
Yeah, this is the one part I worry I'm not fully understanding things, but for anyone looking at this company, these are going to be a bit of a black box. And I know a bank, any sort of lending institution, has some black box qualities where you just have to trust the management is being smart and making good loans, similar to an insurance operation. I think this is the hardest part to analyze, and this is the quote-unquote other loans they hold on the balance sheet. These are loans that are not FFELP loans or a part of Nelnet Bank, and they are becoming a larger part of the portfolio. Now, some of these loans are securitization, which management went into detail about on its annual letter. I don't know if I'll read the full quote here, but they talked about how in 2017, they made their first consumer loan purchases via a partnership with private credit, and they tried to build their expertise ever since. So they have currently a stake in over 30 consumer deals representing about $1.2 billion of loans. They have funded $363 million of them and forecast an overall pre-tax IRR in the mid-teens. I think that last part's important if you trust management here and their track record over the last few decades, where if they have that mid-teens IRR, that's good with me. And again, all we can do here is trust that Nelnet is making smart underwriting decisions when investing in these securitizations or taking on fully owned loans on the balance sheet. They are also, as I mentioned here, having wholly owned loans on the balance sheet. They purchased $600 million of consumer and other non-FFELP loans just in 2024. So that is a huge portion of Nelnet's capital getting deployed in these loans. So a ton of the reinvestment are going into these. Okay. So if we look at the balance sheet, this reinvestment will be included in the assets part of the balance sheet, and they're going to be in the quote of the line item that says private and consumer loan originations and quote other investments. Now, not all of the other investments are NFS loans. They could be, you have venture capital investments, you have the stake in Hudl, you have some of the solar stuff that could be mixed in there, real estate. But aside, some of those are within NFS. But I'm saying with these consumer loans and the private credit loans, a large portion are. And the Nelnet has poured almost $4 billion into both of these line items since 2015, some of that including solar and real estate and stuff like that. And it's at an accelerating pace. And if these loans achieve the teens annual returns that management is forecasting, I think it can create a lot of value for shareholders, but you are just trusting them at the end of the day. Combined, we're not even including the real estate. We're not even including the reinsurance operations. There's the, I didn't even mention the financial advisory service that generates some earnings as well. I think NFS as a whole, if we talk about FFELP, now that bank, all this stuff can generate, I think, hundreds of millions in owner earnings to Nelnet in 2025 and beyond. Once this FFELP book runs out, essentially, what we're saying, it goes into a much smaller period in 2026. The earnings might drop a little bit for that year, but I think after that, they should begin to grow again. And how much is this segment worth? That's tough, right, Ryan? Maybe we have a book value of, would you say 3 billion of with this? Does that make sense to you?
Yeah, maybe. Yeah, I think that's probably fine. I mean, okay, you're getting at least $1 billion in guaranteed cash flow from FFELP over the next decade, whatever that's
the
worth.
Book value of that is yeah. And then you have this NFS stuff that's the other is gonna have even more, I think, of a book value there.
Yeah, I think 3 is reasonable. If it's a little less, if it's somewhere in the 2 range, it's not a deal breaker. So I don't think it's the end of the world there. Part of this is that I get a little concerned when I see all the different sprawling initiatives within this category. So the VC arm, the real estate arm, my worry is that, like, is the management team so good they can see a deal in any industry? Is that what it feels like? But ultimately, the bulk here is loans around the education sector, which they have a phenomenal pedigree in and phenomenal history in writing and originating those. So I think they're great at it. And I wouldn't get too worried about this feeling like a black box. And part of the reason for that is because they have other divisions now that account for a good chunk of the valuation.
Yeah, and the balance sheet is pretty conservative. They have a lot of capital built up, and the historical track record has been quite good. Now, if we have this $3 billion in book value, I think quite conservatively, if it's earning a IRR or ROE or however you want to say it, of 15%, I think valuing it at book value is well conservative enough, especially when you consider some of these other startups, subsidiaries within this, like the insurance, the real estate that goes on top of that. Again, it's very hard to parse through the true size of everything, but let's say napkin math, it's worth $3 billion to Nelnet, if not more, with hopefully a good reinvestment runway over the next 5 to 10 years.
Yeah. All right. Let's shift gears a bit and talk about some of the other divisions here. I'm going to be speaking for a while because I'm going to take some of these divisions, but hopefully we can, there'll be plenty of questions to ask about all these. And I'm going to kick things off with the Nelnet Diversified Services. This is basically just their loan servicing division. For anyone that doesn't know what that means, it's the layer between the lender and the borrower. So the work that's being done under the hood, that includes the actual distribution and collection of money, maintenance of financial records, and sort of being a central dashboard for the borrowers to interface with during the payback period. This is really if you borrowed a student loan to go through college, there's a good chance you probably know Nelnet's name, and part of that might be the servicing. So the last 2 years in this division have been really difficult. Really, you could say the last 5 years have been pretty difficult in this division. The COVID response put loans into a forbearance period, and then the Biden administration continuously renewed the forbearance period on the hopes that they were going to be able to get broad loan forgiveness. And it really hasn't amounted to much so far. And there's been, as Brett said, a lot of court dates, a lot of lengthy legal trials, going basically appealing this. So here's what the management team has said about the situation. They said, during the Biden administration's final year, they threw every ounce of remaining caution to the wind and went full force to discharge as many categories of loans as possible using their interpretation of existing authorities, including income contingent repayment authority, borrower defense to repayment, and even another attempt at broad forgiveness. Unsurprisingly, Republican-led states challenged the legality of many of the administration's forgiveness actions, with court rulings leading to repayment starts and stops that will likely continue into next year. So you can see they've been kind of whipped around by the federal government on these loan programs, and they have to staff people based on the number of borrowers and the people repaying, and so they've had a number of firings. They've had just costs kind of going all over the place, revenue going all over the place. And then on top of that, they had a new contract start, which is really kind of, I think, what matters the most probably when you're forecasting out long-term earnings for this division. So their old deal with the U.S. government expired last year, and they entered into a new one starting in April. As a part of the deal they had, or as a part of this new deal, they had to make some big technology investments. They had to make what they put in quotes as personnel restructuring. I honestly don't know what that means. Typically, you see that
layoffs.
The federal government made them do layoffs.
No, they're saying that they can't be profitable at the current rate unless they have fewer employees.
Okay, all right,
Yeah.
that's what I thought. I just never. It sounded like it was like a part of the agreement, but okay, that makes sense. And then they were given a lower revenue per borrower rate, which is kind of a bummer to see.
And that's what caused the restructuring and the layoffs. Yeah.
Right. So this led to a pretty big drop in earnings for this year for the segment. To put some numbers on it, last year they did $78 million in earnings. They were kind of doing around 60 to 70 million before that. And then this year they did 40 million. It might even be lower since the new contract started 4 months into this year moving forward. But in general, it was a bad year for loan servicing. I'm not sure it's going to get much better anytime soon. And here's what Michael Dunlap had to say about it. He said, I get asked a lot why we like this highly erratic business. We have been in this business for 46 years and have been able to navigate through many different political ideologies, which makes us most experienced and largest servicer of student loans in the world. We leverage our expertise in FFLP, government, private student loans, and consumer loans to grow our servicing and financing of assets. Here's the part that I didn't really jive with. It said, there are thousands of new companies being started in AI. We don't have that competitive problem, but we do have the opportunity to apply AI to our businesses and to provide a higher level of quality, convenience, and efficiency. He also basically said it's going to take some time to get the earnings back in this division. I don't love it kind of feels like a cop-out to be like, why do I like this business? Well, we've been in it for a long time, but at least we don't have the competitive stuff that AI has. And it's like, yeah, but you're getting toyed with by the government. Maybe it's better to sell this to someone if you can.
Maybe, but they're not doing that. They're taking on Discover and SoFi servicing. They always say this with their servicing, and the earnings are always positive. So it's not like it's a drag like this solar construction acquisition is. That if earnings go negative, that's when I would be concerned. But they always have this very, very pessimistic tone, and then earnings are positive. We'll
True.
see. if they make these improvements and things kind of normalize and there isn't this rapid change and roller coaster ride with negotiating with the government, which I don't think it can get worse than it has been over the last 3 years. Maybe earnings will start to grow again, but who knows? They've been positive. What's your chart here? 10-year chart. They've been positive since, or even longer, since 2012. Positive earnings in this division. Whatever the size is, I'm okay with it.
Yeah, and it's not critical. It's not going to be as critical as sort of the education software segment, but it's not a wonderful business. There is something to be said for if everyone else hates this business as much as, or if it's been as tough of an experience for other servicers as it has been for Nelnet, although no one really has that same contract with the government, maybe there's some consolidation here, and they could be kind of the last player, and maybe pricing looks a little bit different next time there's the contract renewal. But yeah, I think I would probably value this at less than 10 times earnings before taxes. You can maybe even say 5 times. Hopefully they are earning more in 5 years than they earned last year, but I have
I would say maybe 5 times your estimate of what, like 5 times maybe the 60 to 70 million you think they can get to, which is, I guess, what you came up with.
Yeah, I'd say it's around anywhere from $200 to $400 million is what I think this whole segment is worth. Hopefully it's in the 300 to 400 range, but yeah, I'd like to see a full year under this new contract and have them kind of maybe, I don't know if we're going to see it this year, but one where they're not whipped around as much by the US government and there's a little more easy going, that people are going to repay and you're not worried about that. So we'll see if that happens anytime within the next year, but I'd be surprised if it did.
Yeah, this might be the one part of the government or government contractors where there's less whiplash in 2025 compared to 2023 and 2024. But we shall see. Not an important part of the business. What is important is the Nelnet Business Services, which is education software and payments technology. If the NFS Financial Services Division was maybe a case study in a good business that takes strong execution to really elevate yourself to strong ROEs, and if this loan servicing one is a bad business because of the volatility and uncertainty over the government contracts, well, NBS or Nelnet Business Services might be a case study in a high quality business. So Ryan, why don't you give an update on how perhaps both of our favorite parts of the Nelnet story did in 2024? All right, listeners, we've got a new sponsor here at Chit Chat Stocks, and their name is Blue Chippers Club. Blue Chippers Club was recently started by 2 friends of ours with the goal of building a tight-knit community of stock-focused investors. Inside this community, everyone gets to share and break down their portfolios, pitch stocks, receive feedback, and participate in weekly calls. We truly love this idea, and it's why we're promoting it here on the show. In fact, we are in this community ourselves and enjoy just how much value we get by collaborating with other investors. If you're interested in joining, head on over to bluechippersclub.com and hit apply. Right now, it is completely free to join. The link is in the description. All right, if you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA-registered, SIPC-insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/chitchatstocks and get up to $10,000 when you transfer your old portfolio. That's public.com/chitchatstocks, paid for by Public Investing. Full disclosures in the podcast description.
Yeah, and I think it's more than just our favorite part. It's probably management's too. I think at one point, a couple of years ago, when Nelnet was much cheaper, Jeff Nordick said that this business alone could be worth the total enterprise value of Nelnet. Well, I don't know if that totally holds still. Depends what kind of valuation you'd give this company. But yeah, this is the education software business. It includes a number of different software and payment systems for all grade levels of school. So this includes like tuition management, payment processing, other software tools focused on the administration departments at schools, mainly in the United States. And if you just break out the revenue and earnings of this business, it looks phenomenal. So in 2012, now keep in mind there's been some acquisitions along the way.
I'll share this chart for the video watchers.
Okay, in 2012, they were doing $74 million in revenue and $15 million in earnings before taxes. This year, they technically did more than $500 million in revenue and more $118 million in earnings before taxes. So they have compounded both revenue and earnings at high teens percentage rate, annual percentage rate for the last 12 years. It's a very sticky business as well. So
97% retention. Yeah. Or were you about to say that?
Yeah. Customer retention's 97%. I mean, you think about being kind of in the workflows for administrative offices at elementary schools or colleges, or the payments processing for colleges. That's probably not something you want to be switching around on a regular basis. So yes, retention is high. I imagine there's probably some pricing power at some of these software divisions as well. And then the only thing that's probably worth noting is that Dunlap said there was a number of one-time earnings opportunities that they don't anticipate will be there in 2025. I looked through the 10K. I couldn't find how much that amounted to. But I suspect they will, even if they don't grow revenue this year, it seems like a business that can very naturally grow. If you work in the front office at a school and you switch schools and you know that you really liked Nelnet's payment processing service, when you go in there, you can say, oh, I imagine there's sort of some virality in that sense where you switch schools, maybe you try the different payments processing. They have a phenomenal net promoter score, even though I kind of hate when companies call that out. It's better to have a good one than a bad one. So yeah, high retention, high net promoter score, great earnings power. They also had $30 million in interest income. So I imagine there's cash being held in some of these software businesses, probably the payments processing, stuff like that, where they can earn interest. They processed, I believe, it was more than $50 billion in payments volume this year.
That's correct.
Not surprising to see some interest earned there. I think this business, one that is very sticky, one that has natural growth, probably some pricing power, and is quite profitable. I think this business is worth 20 times trailing earnings before taxes, which is kind of a premium. But if this were split out on its own, I would be very surprised if this was trading for less than 20 times.
Yeah, and that's not the best way we like to do things, where it's, relative valuation. What are peers trading at? But I think if you look at this business, the attractive cash flow, the asset-light nature, over the next 10 years, you probably get close to the entire market cap in cash back. If that market cap was $2.3 billion, maybe a tad less. But for a high-quality business with very low churn and solid growth potential going forward, probably not as good as it has been historically, but still very solid. Yeah, it's not the end of the world to have something spitting out over $100 million in cash flow a year, especially when combined with the volatile nature of the lending and banking operations and how that can unfold.
Yeah, it's so nice to see like a software business in here, because the rest of it's very unpredictable, and this one feels extremely predictable. So yeah, that in my opinion is the biggest chunk of the price you pay today for Nelnet, or the price or what I think the business is worth. I would say it's right up there with the financial services, and because it's so much easier to analyze, it makes me way more confident in our valuation process and what we value the business at.
Yeah, the NFS could earn hundreds of millions of dollars a year in earnings, but it's a bit messy right now. So maybe that'll clear up within a few years as we get this FFELP stuff, pretty much wound down. But as of now, it's much more cleaner to look at. NBS hey, over $100 million in earnings, very strong track record of consistent growth, and a very low churn business with a fantastic unit economics and cash flow characteristics. That's all we're looking for, Ryan. Let's move on to two investments. Now, what I think is funny is that I said, oh, these ones will be short for you, but I think you like both of these investments, so you had no problem going in a little bit of detail of what they are worth. First one we have is Hudl, which is a third-party investment they have, but a strong relationship with the company that's also headquartered in Lincoln, Nebraska. So, Ryan, talk us through what you think this is worth, because they gave some pretty good clarity, or not clarity, some good color on the business today. And they actually disclosed the true number of what they own. They used to say, well, we own about 20% of this business, but at least this year they gave us a true number of 22%, where we can do some hopefully good valuation work on it.
Yeah. So just as a reminder on what Hudl is, they are a software and somewhat becoming a hardware provider as well to the entire world of sports. And the reason I say they're becoming hardware is they're like planting these cameras at various fields so that they can provide film, video. There's a
Live
whole
stream
bunch.
games for high
Like,
schoolers, that's a huge problem, honestly. Like I remember we both had that problem. Do you remember the problem of, because we were both kickers, and when the freshmen would be doing the film and they would just have it on the kick and they wouldn't even show if it went in. So when talking to college recruiters, that can be quite the problem. No, trust me, I made that one. Just look, just trust me.
it is, yeah.
It's a problem to be solved.
They have really a monopoly in the US, especially high school football type market. But analytics, video, all that stuff, Hudl is becoming the premier player. Here's a quote from what Nelnet's management team had to say. They said, the company serves the entire sports ecosystem, coaches, administrators, analysts, athletes, recruiters, fans, parents, and brands at every level of play. Hudl is the industry standard solution like Procore is for construction management, Appfolio is for property management, or Shopify is for e-commerce. I think that's dead on, honestly, within the sports analytics and film category.
For the coach, for the athletic directors, this is your workplace management software. Well, mainly the coaches, maybe not the athletic directors. For the coaches.
In more and more is coming into Hudl's sort of umbrella, like ticketing, live streaming. If you're an administrator, you got to make sure that the live stream is available for various, parents, whatever. That's in your wheelhouse. If you're an administrator, it's also, you worry about it as a coach, and for college coaches, they're looking at Hudl film too, all this stuff. Anyway, so they added yet again to their investment in Hudl this year. They invested $3 million, which I believe had to be just them buying some other investor's stake, because this was, quote, not considered an observable market transaction.
Shame.
Big shame. So they are able to hold their stake in Hudl basically at cost. So right now they've got a 22% stake in the company, which they say the carrying value is $169 million. I think it absolutely has to be worth more than that, especially if the company ever went public. They serve 300,000 teams around the globe. And I saw an estimate. I don't know how it was one of the aggregators, but I think it was right. And I've never seen this figure yet, but it said as of January 2025, Hudl had annual revenues of $750 million. That seems reasonable. What do you say?
I agree. Now, I'm going to confirm it right now, but if we look at Hudl's pricing, I believe, and think about the pricing power they could have here for a high school football team. Now, I believe their base price for high school is $1,000 a year. Let's see.
I think you might be way
or
up.
maybe it's a
I think
little
it might be 10
higher
grand.
than
Because
10 grand?
Well, it depends, because they have like multi-sport bundles. They've got like, you can't go onto the website and see the pricing. I think you have to talk to a sales consultant. But
well, that's changed, because I used to be able to find it.
The administrator, like if you're an administrator, you can get Hudl's film capabilities for your whole school, for all the athletic departments at your school. That's great. And I
found a number, Ryan.
Yeah.
Packages start. Yeah, you can't get they have to quote you, but it says packages start from $2,000 a year.
Okay. So I'm not sure what that adds up to in revenue, but I think the 750 million in annual revenue is reasonable, especially because they're also serving like pro sports teams. There's a couple of different software analytics providers that they've bought that serve like the international soccer or football market. Y Scout. I think one of them is the basketball one as well for pro teams or college teams.
They have quite a few. I believe it's called Crossover. I think they've kind of gone on a, what do they call it, roll-up strategy within this software, where Hudl was the premier one for high school football and a little bit of college, but now they're going to, hey, there's plenty of other sports out there, especially globally.
If this got an average SaaS multiple in the public markets, let's call it 7 times revenue, which I would guess with their growth rate is maybe even conservative for what some software businesses could get or what this business could get in the public markets today. Hudl at 7 times revenue, Hudl would have a $5 billion market cap. That would make Nelnet stake worth $1 billion. Only issue is I have seen zero indication that Hudl's going to go public. And the fact that investors are selling to Nelnet tells me that Hudl continues to push off an IPO because those VCs got to return capital to their LPs. So the only way they can get a liquidity event is to sell their stake to Nelnet.
What about an LBO? What Hudl's?
They could.
Hudl's founders on the board of Nelnet. They potentially could get the financing if they got some fixed cost debt to acquire this whole thing. What do you think? Would you like that or no?
I would love that, but I don't think it's going to happen.
Yeah, and it probably would be too expensive. And I think, honestly, the better opportunity is to have them go public, because what Nelnet would pay for this business is not what the market would pay.
Exactly. FinChat.io is the complete stock research terminal for fundamental investors. They have robust financial data on more than 100,000 stocks globally. That includes more than 10 years of income statements, balance sheet, cash flow, and even company-specific segment and KPI data. Want to see Amazon's advertising revenue? FinChat tracks it. Like to track NVIDIA's data center business? They've got that too. The breadth of FinChat's segment and KPI data is truly one of a kind. You can go to finchat.io/chitchat to get 15% off any paid plans. If you sign up today, you will automatically get 2 weeks of FinChat Pro for free, no card required. Again, that's finchat.io/chitchat. The link will be in the show notes. So it's obviously worth more than their cost, but Nelnet won't see the cash flows from it, I imagine, for a long time. So I'm going to give it a market value of 2 times their cost. So that puts it at just over $300 million. Not huge part of the enterprise value or the sum of the parts valuation, but it could be. I mean, this could be a $1 billion, $2 billion stake if
a lot of upside
in a successful IPO. So yeah, I really love that business as well. Brett and I both have. It's been around for a long time, and it's been the premier provider for probably a decade plus now.
That is correct. Yeah, I remember. Hey, sending the film, watching other people's films, but it is hard to, again, the film aspect and being kind of vertically integrated within that market. We both know that there is a huge opportunity there, and that is a big problem to solve for these high school teams, and Hudl's in the driver's seat to solve that. All right, next one is Allo. This is another one where management might be trying as hard as possible to make it confusing to shareholders and what this is valued at, Ryan. But this is a fiber communications business. Seems to be growing quite quickly, but they only own a 45% voting stake in the business, or I think economic value as well. Not exactly sure, but take us through the details here. How is this business progressing in 2025, and what do you think it's worth?
Yeah, so Allo is their fiber internet business. As you mentioned, they own a 45% voting stake in Allo Communications. It's primarily around Nebraska and some neighboring states as well, Colorado, stuff like that. And they also have preferred stock with a carrying value of $225 million. So, and for context, the carrying value on the preferred stock was $155 million 2 years ago. So
not bad. Hey,
the carrying value continues to go up. But before I expand on what I think the 45% equity stake, the non-preferred, could be worth, let's go through the business. This is something I am growing more and more optimistic about. So they grew customers 25% year over year. They now serve just over 200,000 customers in total. So that includes residential plus commercial. And their total home passings grew 43%, standing now at 626,000 passings. For reference, home passings is exactly what it sounds like. It's just the number of homes Allo's fiber passes. So basically, it's the number of homes that they could serve right now if the homes became customers. The run rate revenue for Allo stood at $200 million at the end of this year. Here's a quote that stood out to me. As total passings are now more than 626,000, we expect the opportunity to increase revenues through market share and wallet share is meaningful. The cash flows from these mature markets have enabled Allo to complete 2 asset-backed securitizations, making meaningful progress to a self-funded state. As the attractive non-fiber markets are decreasing rapidly, Allo expects construction and CapEx will trend downward over the next few years. I'm not a fiber expert, but I have to imagine that these investments it's not like you're buying chips, which depreciate really quickly. The fiber assets depreciate very, very slowly. Their IRS useful life is 24 years. And I think it's way better than traditional internet, just from a customer perspective. So
it's faster for anyone that doesn't know. It's much faster.
Yeah, it's not like they're potentially throwing money into the ground, both figuratively and literally, because even if the customers don't sign on in the first year, even if they don't sign on in the second year, the fiber itself is still a valuable asset, and you've still got 22 years on the useful life there for the customer to pay you, and there's probably some pricing power there as well. If you got fast internet, hey, I'll take a $5 upcharge if I've never had an issue with my internet.
And there's operating leverage. And one thing I liked from the shareholder letter is that they are gaining market share within existing markets. That was a bit redundant. They are gaining market share, which will really help them leverage these fixed costs and hopefully lead to positive free cash flow.
Value in stake is pretty difficult, though, because they carry more than $1 billion of debt outstanding, 1.14, which is an increase from approximately $715 million last year. So they're using leverage, and frankly, a lot of leverage now to grow. We don't know the terms on the debt, but
if this was an individual company and that's all you were investing in, I would be concerned with this debt level. Obviously, over $1 billion in debt, $200 million in revenue. What are margins going to be like? What is operating cash flow look like? I'm not so sure. But we have 2 big backstops for this business that can provide more capital if need be. Nelnet, with its balance sheet that could definitely provide some more funding here if need be, and their capital partner, SDC. So they have 2 large partners here that make this a little less wobbly than you would think.
Yeah, the other part here is, look, someone is continuing to provide them leverage, and I don't think they're doing so on the hopes that they don't pay it back. Like, something's telling me that they're seeing clarity, or they're seeing that they can clearly pay this back over time. Maybe having those capital partners helps. But the other part is Nelnet currently carries the value of this position at $0. So even if at least the non-preferred part. So even if this went to zero from zero, it's not a make or break once again for Nelnet's thesis. They value these things conservatively all the time. And this isn't the type of business, like Nelnet has never shown a lack of conservativeness. They've always been erring on the side of caution. So something tells me that they're not on the hook for the debt. They're a minority owner. That helps. But I think they're supportive of this this leverage growth strategy because they think the returns are there, would be my suspicion. So
the growth is good. To sum it up, the growth is good. And depending on, You have the preferred and the voting stakes. So remember, they have 45% of, I think, the common stake. Again, we might be getting some of this wrong. But if this business continues to scale and it's doing down the line $100 million, $200 million in earnings a year, Nelnet stake could be worth $1 billion, perhaps more. Say it's worth less. You just have it pegged at the preferred stock here, but a lot of upside. And regardless of whether this is important to the valuation today, things are going well for Allo.
Yeah, the way they value the equity stake on the balance sheet is using the hypothetical liquidation at book value method of accounting, which seems conservative to say the least.
It seems also like I don't know why this is allowed because they're doing it for
inaccurate
tax purposes. But yeah, it's not accurate. Like this shouldn't be how you do things. But hey, they're able to do it.
So I'm just valuing it at what they carry their preferred stock at, which is 225 million. So once again, we're going to get into the overall sum of the parts. It won't be a huge piece of it, but it's additive overall to the valuation.
Yeah, and it could help over the long term, especially if things work out and they keep scaling this business. Again, could be worth $1 billion if they own about half this thing. Let's move on to the last segment. Yes, there is one more, and that is solar energy. It's another complicated segment for Nelnet. It's also the one that's doing bad and is actually probably hurting the intrinsic value of this business at the moment. They have two divisions in solar energy: tax equity investments and renewable energy construction. Nelnet originates and syndicates solar tax equity investments, which gives them tax credits to offset taxable income, and they get cash flow once the projects come online. At the end of 2024, Nelnet had cumulatively invested $315 million in solar projects and managed $271.4 million in solar investments for third parties. Here is a quote to explain the economics of these deals. These investments provide a federal income tax credit under the Internal Revenue Code, currently equaling 30% to 70% of the eligible project cost, with the tax credit available when the project is placed in service. The company is then allowed to reduce its tax estimates paid to the U.S. Treasury based on the credits earned. In addition to the credits, the company structures the investments to receive quarterly distributions of cash from the operating earnings of the solar project for a period of at least 5 years after the project is placed in service. That sounds like an attractive business to me. You offset the taxes from your other operations, and you get cash flow coming in. You're not the one building the project. However, they made an acquisition to try to start building these projects with renewable energy construction. They made this one, I think, in early 2022? I think it was mid 2022. It's a very poorly performing acquisition. Luckily, not that large, but still a drag on the earnings last year. They posted a $34 million net loss for the renewable and solar energy construction in 2023 and $26 million in 2024. Now, it's gotten rid of its unprofitable residential division and is now focusing solely on commercial construction, but we'll see what the earnings look like in 2025. I think it would be a positive if they were just flat. The largest risk to this segment is the elimination of the tax credit loophole in the United States for solar projects. I have no idea how likely this is, but it's a serious risk. Of course, we don't want the construction segment to lose money, but maybe I'll value that at zero. I think they can get it to break even, right? That seems fair. I think that seems conservative. So if we add up, and just try to be conservative overall. If we just add up the capital deployed into this segment, and then think of the tax credits, think of the consistent cash flow coming in when these projects are completed, and then the fees earned on the investments it manages for third parties, I think I would peg the valuation of the solar segment at $500 million, assuming the construction business is worth zero. Does that make sense to you, Ryan?
I think the construction business might be worth less than zero.
Oh, they said the commercial is profitable. I would say it's probably worth more than zero if they get rid of this residential one.
I thought they said they are expecting losses again this year.
I think they're hoping not to have losses, but they're still winding down some of the residential projects.
Okay. While we're on the topic, I'm going to give a quote from Michael Dunlap in this year's letter, and it talks about this. He says, If I were to rank my favorite pies, the order would be simple: apple, cherry, and then pumpkin. One
You're
pie I
saying
could
this guy's from the Midwest?
I know. He says one pie I could do without, however, is humble pie. Unfortunately, for the second year running, that's exactly what I'm eating. Humble pie that tastes like the overcooked Brussels sprouts and canned asparagus my mom served me as a child, long before chefs made Brussels sprouts delicious. NRE, our solar construction business, has once again drained resources after $34 million in net losses, excluding losses attributed to our minority partners, which includes $21 million in goodwill and intangible assets write-offs in 2023. I optimistically thought the worst was behind us, but 2024 presented continued challenges, including shutting down the residential side of the business, inventory write-downs, construction issues, bad estimates, and inflation amounting to an additional $26 million in net losses. Venturing beyond our circle of competence rarely ends well. Yeah, I imagine. Okay, so they're shutting down the residential business. That's good. If this commercial business is profitable, that's great. But I
That's
feel
why I'm
like,
paying it at zero, Ryan.
okay, I'm hoping that they just get it to positive earnings.
Yeah. And either way, even if it's at zero, if the solar tax equity investments are there and you can use that to grow that segment, if you can use the construction to grow the amount of capital you can deploy in these solar tax equity deals, which seem highly attractive, I think that's good. Because there's no way they are doing these deals when they see mid-teens IRRs at the NFS division. They have to be seeing similar numbers within solar equity investments. And it looks like, given the outlines here, of the 30 to 70% tax credit you can get, plus the consistent cash flow that's coming in year after year and quarter after quarter when these deals come online, that's got to be worth, I'm conservatively putting it at essentially what the cash they've deployed plus what they're managing for third parties. But I think it's probably worth more.
Okay, let's finish with our valuation and our final thoughts on maybe whether we're buying, selling, and everything else. Do you want to give us the full valuation update?
Yeah, let's do some of the parts. I know a lot of you hate some of the parts, but for this one, it can work. I'm going to go to this part first and just explain why it can work. Because unlike other conglomerates, Nelnet is aggressive at consistently buying back stock. Their shares outstanding have come down by 33% since 2005. Dividend per share consistently grows, so we should see it, that the value is going to get back to us eventually. We just have to be patient. All right. So I pegged the NFS division to be worth $3 billion, solar to be worth $500 million. Ryan is valuing loan servicing at $300 million. NBS, which is the education software and payments, at $2.3 billion. Hudl at $300 million. Allo Communications at $225 million. And we have about $200 million in cash on the balance sheet. Total, that is $6.8 billion. The market cap today is $4.4 billion. I see really no reason to sell. And in all honesty, I probably wouldn't sell unless we got very, very aggressively above our estimate of intrinsic value, maybe $10 billion. Because you got to take the tax hit, depending on what account it's in. And if you have something better, let your winners ride as long as the business is doing well. That's the one takeaway we'd had from David Gardner. And the rule, at least I have, I think Ryan does as well, you probably want to be very hesitant on selling your winners unless the valuation gets absolutely extreme, which I'm not too worried about with Nelnet, given that it never seems to trade at a premium valuation.
Yeah, given that they have no conference calls and like zero analysts that follow it, and the likelihood of it becoming a meme stock seems pretty low, I suspect this one won't get to extreme valuation territory. If it does, great for me, I guess. But yeah, are you, when you first started buying this, which is in 2020,
Yeah.
would you say this has exceeded or come below what you expected the next 5 years to look like?
Exceeded. Yeah. Because at that time, we were very worried, or the biggest concern is what they're going to do with the FFELP portfolio runoff. Now we figured it out. that can put it into these new lending operations, real estate, reinsurance, the bank, and solar tax equity investments. Not all of them have worked out fantastic, but I think there is a lot of value getting created here. Now, another way we can look at the valuation is book value. Price to book value right now is 1.33. Now, if you're a deep value guy, that might turn you off right away. Oh my God, it's above book value. How could I ever buy this thing? Yes, it's less attractive than when it traded at 0.9 times book value at the beginning of 2024. But I hope as you listen to this episode, you understand that their true intrinsic value is much higher than the accounting book value on the balance sheet at the end of 2024. And despite that, if we look at that number that you gave at the beginning here, their book value per share plus dividends have compounded at a 15.7% rate since 2004, with a lot of asset light and headwinds to this accounting book value, despite there being significant amount of other value being created in those assets like Hudl, solar tax equity, things like that. And not to mention the software and education payments business. So I think exceeded my expectations. I like the consistent buyback. I would maybe want them to take some of that cash flow and maybe be more aggressive with that buyback to close the gap with intrinsic value, but I don't expect that to happen. That would be my wish. I don't think it's going to happen. I wouldn't. It's not like I'm going to sell if that happens to me as a shareholder, but I'm very happy with the position. It's in a hold, not sell. Would probably buy some more if it becomes a smaller position in my portfolio as I get more of my income deposited into my account. But I think that's all I have to say. Ryan, what are your closing thoughts? Did it exceed? Disappoint you? What are your thoughts on Nelnet as we close out here and look forward to 2025?
I'd love to say that it exceeded my expectations, but I think if I went back to our write-ups and the podcast that we did at those times, it probably came a little under my expectations. Certain segments have overperformed. I think Nelnet Business Services has overperformed what I would have expected. The servicing is certainly worth less than I projected it to be worth 4 years ago. And it seems like they've done a good job finding places to reallocate the cash flow from the loan portfolio. But I think it kind of remains to be seen what this future loan portfolio looks like and how they perform. I think it's done pretty well so far, and I suspect that given their history in education loan underwriting, they should do just fine. But I see no reason to sell right now. I'll probably just continue to own shares. I'm not really buying here, but I'm comfortable holding.
Yeah, and we should mention that it is, I think for you as well, about 10% of the portfolio or higher. But we do these updates throughout the year where we have anyone can ask us what our portfolio is, especially if we're going to talk about stuff that we own. We're fully transparent with that. Is that correct or wrong? Or maybe you're under 10%?
Mine's about 7%. It's like my third largest holding.
Okay, so still a large position. For me, it's a bit higher. I think it's 20, but probably will come down as a percentage over time. We'll see, though. Maybe I'm a bit more optimistic than you, Ryan, here, but we're both optimistic on the company. Let's close things out. I think this was a fun overview. We had a lot of people asking to do an overview on Nelnet, and hopefully this was a good episode for you guys to listen. If you liked the episode, again, if you got this far, consider taking 5 seconds and give us a review on Spotify or Apple Podcasts. Subscribe to the newsletter for all the charts, written content that goes along with this update, and feel free to chat with us on the Substack chat application on any of these episodes or any stocks you're interested in talking about. As a disclosure, we are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, once again, and we'll see you next time.